Hey everyone, let's talk about making money with crypto, even when the market's tanking. Join me as I try to make money using stable coins in this bear market. Let's see if I can turn the tides. The crypto market is unpredictable and bear markets can be particularly brutal. We've all seen it, and maybe some of us have even felt it. You see your portfolio shrinking and start thinking, should I sell? Well, today I'm going to tell you about a way you might not have to. However, stablecoins present a unique opportunity to generate income even in times of market downturns. In this video, we're diving deep into 3 powerful strategies to make stablecoins work for you, even in a bear market. We'll explore the ins and outs of yield farming, break down how lending platforms can generate passive income, and uncover the potential of algorithmic stablecoins. So, buckle up, hit that subscribe button, and let's get started. Alright, let's dive into the world of yield farming. Imagine this. You're lending your stablecoins to a decentralized finance protocol, or DeFi for short, and in return you're earning interest. It's like putting your money in a high-yield savings account, but instead of a traditional bank, you're dealing with a decentralized platform. Now, when it comes to yield farming, there are a few major players you need to know. We're talking about platforms like Compound, Aave, and Curve Finance. These are like the heavy hitters in the DeFi space. They've got massive pools of liquidity, and that means more opportunities for you to earn those sweet returns. But here's the thing about yield farming. It's not without its risks. The DeFi space is still relatively new, and with that comes the potential for smart contract vulnerabilities or even rug pulls. Remember, we're talking about decentralized platforms, which means there's no central authority to bail you out if things go south. The earning potential with yield farming can be significantly higher than your traditional savings account. I'm talking anywhere from 2% to even double-digit annual percentage yields, or APY. But remember, higher potential returns often come with higher risks. So how do you actually get started with yield farming? First, you'll need a crypto wallet compatible with the DeFi platform you choose. MetaMask and Trust Wallet are 2 popular options. Once your wallet is set up, connect it to the platform and deposit your stablecoins. Choose a lending pool that aligns with your risk tolerance. Some pools offer higher APYs but come with greater risk, while others offer more stability but lower returns. It's all about finding that sweet spot that works for you. And remember, it's never a good idea to put all your eggs in one basket. Diversifying your investments across different platforms and pools can help mitigate your overall risk. Now, you might be thinking, Graham, this all sounds great, but is it really worth the risk? And that's a valid question. Yield farming can be a great way to earn passive income on your stablecoins, but it's crucial to do your research and understand the risks involved before you jump in head first. Don't just ape into a project because you see a bunch of YouTubers talking about it. Take the time to understand the underlying technology, the team behind the project, and the potential risks involved. Remember, in the world of DeFi, knowledge is power. Let's move on to another great way to make your stable coins work for you. Lending platforms. Think of it like being the bank, but without all the overhead and paperwork. You lend out your stable coins, people pay you interest, and you earn passive income while you sleep. It's a pretty sweet deal. Now, in the crypto lending space, there are a few big names you need to know about. BlockFi, Nexo, and Celsius. These platforms have gained massive popularity in recent years, and for good reason. They offer a user-friendly way to earn interest on your crypto, and they typically offer higher rates than traditional savings accounts. But before you go and dump all your stable coins into one of these platforms, it's important to understand how they work and the risks involved. These platforms essentially act as intermediaries between borrowers and lenders. They pool together crypto deposits from lenders like you and me, and then lend those funds out to borrowers who pay interest on their loans. The interest rates offered on these platforms can vary depending on a few factors, including the specific platform, the type of cryptocurrency you're lending, and the loan duration. But generally speaking, you can expect to earn anywhere from 4% to 8% APY on your stablecoins, which is significantly higher than the national average for savings accounts. But remember, like any investment, there are risks involved. One of the biggest risks with crypto lending platforms is the potential for platform insolvency. While these platforms generally have risk management protocols in place, there's always the chance that they could experience losses on their loans, which could impact their ability to repay lenders. Another risk to consider is the potential for security breaches. Cryptocurrency is a prime target for hackers, and lending platforms are no exception. It's crucial to choose a platform with robust security measures in place, such as two-factor authentication and cold storage for a majority of their funds. So, should you consider using a crypto lending platform? Well, if you're looking for a way to earn passive income on your stablecoins, it can be a viable option. Just make sure you do your due diligence, choose a reputable platform, and understand the risks involved before you deposit any funds. Now, let's step into the exciting and sometimes unpredictable world of algorithmic stablecoins. These digital currencies are designed to maintain a stable value, just like traditional stablecoins, but they do it through some pretty complex algorithms and smart contracts instead of being backed by real-world assets. Think of it like a self-driving car, but for money. One of the most well-known examples of an algorithmic stablecoin is Terra USD, or UST, before its unfortunate collapse. UST was designed to maintain its peg to the US dollar through a complex system involving its sister token, Luna. While it worked well for a while and attracted a lot of investors with its high yields, the system ultimately proved to be unsustainable, leading to a massive crash that sent shockwaves through the entire crypto market. But don't let the UST saga scare you away from algorithmic stablecoins altogether. There are still some promising projects out there like Frax and DAI that are working to create more robust and sustainable models. The beauty of algorithmic stablecoins is that they have the potential to offer even higher yields than traditional stablecoins. Because they're not backed by real-world assets, they can be more capital efficient, allowing them to offer more attractive interest rates to lenders. However, it's important to remember that algorithmic stablecoins are still a relatively new and experimental concept. The risks involved are generally higher than with traditional stablecoins or even lending platforms. Before investing in any algorithmic stablecoin, it's crucial to do your research and understand the underlying mechanisms, the risks involved, and the potential downsides. One of the biggest risks with algorithmic stablecoins is the potential for instability. Unlike traditional stablecoins, which are backed by real-world assets, algorithmic stablecoins rely on complex algorithms and smart contracts to maintain their peg. If these algorithms fail or are exploited, it can lead to a loss of peg and a rapid decline in value, as we saw with UST. Another risk to consider is the potential for regulatory uncertainty. As algorithmic stablecoins gain popularity, they're likely to attract more attention from regulators, who may introduce new rules or restrictions that could impact their use and value. So, are algorithmic stablecoins right for you? Well, if you're a more adventurous investor with a high risk tolerance and you're willing to do your homework, algorithmic stablecoins might be worth exploring. However, if you're looking for a more stable and predictable investment, you might want to stick with traditional stablecoins or lending platforms. Stablecoins can be a valuable tool for navigating the choppy waters of a bear market, but remember, knowledge is your best defense against risk. Remember that no investment is without risk, and it's always best to do your own research and invest responsibly. Don't forget to hit that like button and subscribe for more crypto and personal finance content.